Welcome to today's deep dive. The biggest corporate holders of Bitcoin are currently doing the one thing they swore they would never do.
Right. They are actually selling.
Yeah, they are selling.
Yeah.
But they aren't panicking. They are executing this brilliant mathematical arbitrage. So our mission today is to analyze how publicly traded companies have evolved from, simply hoarding their reserves to actively selling them to mathematically optimize their own equity value.
Exactly. I mean, it is a total paradigm shift. We are moving away from the old idea of just locking assets away indefinitely. Now we are seeing complex arbitrage executed directly on the balance sheet.
Right.
Institutional capital is finally realizing that an asset is really only as good as the leverage it provides your business.
And ProCap Financial is the perfect case study for this. They just liquidated 52 Bitcoin straight into the spot market. But they didn't do this to keep the lights on. They did it specifically to buy back 2 million shares of their own common stock.
Which is a massive move.
It is. It is kind of like owning a wildly successful bakery, but your partners want out. And instead of taking out a loan to buy their shares, you sell off a fully paid-off delivery truck to buy them out at a massive discount.
Yeah, that is the exact mechanism at play here.
So suddenly you own a much larger slice of the bakery's future profits.
Right, and the math here is what makes it so incredibly effective. You have to look at ProCap's net asset value, their NAV. Their verified NAV was $3.47 per share.
Okay.
But on the open market, their stock was trading at just $2.15.
Oh, wow. So the equity is trading at nearly a 50% discount to the actual assets the company holds. I mean, it's essentially on clearance.
Yeah, on clearance. So by selling fully valued Bitcoin, which the market is pricing perfectly, to buy back that dirt cheap equity, ProCap mathematically increased the amount of Bitcoin backing every single remaining share.
Because there are simply fewer shares floating around.
Exactly. I mean, they still hold a massive reserve of 5,405 Bitcoin, but because they retired those 2 million shares, each outstanding share now represents a mathematically larger slice of that pie.
That is wild.
Yeah, they forced an increase in shareholder value without needing the asset's fiat price to move an inch. It is just pure equity optimization.
So ProCap proved you can sell assets to mathematically boost your share price.
Yeah.
But what happens when a company isn't trying to voluntarily optimize equity and is instead forced to pay out actual cash yields?
Right, which is a totally different scenario.
Exactly. And that brings us to Strategy Inc. They just liquidated 32 Bitcoin, netting about $77,135 per coin, specifically to fund cash dividend obligations on their preferred stock, the 11.50% variable rate Series A.
Yeah.
But I have to play devil's advocate here. They are sitting on $900 million in fiat reserves. Why sell a famously scarce asset to pay a fiat yield when you have a mountain of cash sitting right there?
Well, I mean, it is a fair question, but you really have to look at how corporate treasuries manage runway. Using that $900 million fiat reserve drains their primary operating cash.
Right. The money they actually need to run the business.
Exactly. The cash they need for operations and weathering market downturns. By skimming the yield off their appreciated Bitcoin instead, they preserve their core cash while fulfilling those dividend obligations.
Oh, I see.
Yeah, they don't have to touch their operating runway. And crucially, they don't have to take on expensive new debt to pay the dividend.
That completely changes the framing. It treats the asset as like a flexible liquidity tool, an operational lever to manage complex equity structures rather than a sacred cow you can never touch.
Exactly. It is a lever. And if you want to see what happens when a company refuses to use that operational lever, look at Capital B over in Europe. They're doing the exact opposite.
Right.
They recently issued over 384,000 brand new shares just to buy 4 Bitcoin.
Wait, really? Just 4 Bitcoin? That is a massive amount of equity to give up for such a small slice of the asset.
Yeah. And that is precisely how dilution destroys shareholder value. Because they constantly issue new equity to buy the asset, their outstanding share count has bloated to over 300 million.
Wow. So they are just slicing the company into thinner and thinner pieces.
Right. And consequently, the market heavily penalizes them, and their stock trades at a deep discount. It perfectly illustrates exactly why companies cannot just blindly accumulate at all costs. They must actively trade their reserves to protect their equity.
So the corporate playbook has officially evolved. We aren't just looking at companies blindly stacking assets anymore. We are looking at active NAV arbitrage and highly strategic equity management.
Yeah, the balance sheet is a living mechanism. You have to actively manage both sides of it, both the assets and the equity, to actually generate value.
Which leaves you, the listener, with a pretty massive question to ponder today. If corporate giants increasingly view Bitcoin as just another liquid asset, something to be strategically dumped onto the open market whenever their stock price needs a mathematical boost or a dividend comes due, does that fundamentally change the long-term investment thesis for corporate adoption?
Right. It definitely makes you rethink what that asset actually represents to the broader market.
Absolutely. Something to mull over.
Yeah.
Till next time.